whatever that is left in paper one. Okay. I did say before that whenever we're preparing financial statements, we spoke about the income statement, we spoke about the balance sheet, we spoke about the cash flow statement, and then we said there are also notes to the financial statement. So these are the things that we have done so far. We did income statement, we did the balance sheet, and we did the cash flow statement. All these are the statements that are going to be part of the financial statement. So when we're talking about a set of financial statements, we're talking about a financial statement that includes income statement, it includes balance sheet, and it includes cash flow statement, right? What I wanted you guys to take note of is that having these statements separately in the like set of financial statements, I did say that before when we talk about a set of financial statements here, I have the annual financial statements of Clicks Group, right? So we're talking about a document that includes income statement, that includes balance sheet, that includes statement of cash flows, and there's something called statement of changes in equity. And I did say that the statement of changes in equity is only it includes share capital and retained income, but we should not be worrying about that now. And we have note to those financial statements. We did the notes to the financial statements, especially on the balance sheet side. We did note number 1, 2, 3, 4, 5 up until 9. So all these things that you can see here, they make up a set of financial statements. But having done all these statements, it's not enough. We cannot say that we have completed everything that is required in the financial statements. We need the reporting side. That's when now we're going to start seeing what? That's when we're going to start seeing an independent auditor's report. As you guys can see here, we do have what? An independent auditor's report. It is required to be part of the financial statements, right? It is required to be part of the financial statements. And I did say also that there's something called a director's report that we need to talk about. We need these reports in the financial statements. It is a must that these reports, they have to be there so that we get to understand. The directors have to report to the external stakeholders on the performance of the company and the financial position of the company. So they do need to give us this report highlighting the nature of the business, as you can see here. Like there is the nature of the business highlighted by a director's report, group financial results. You see, they're giving us some results, how much profits the company made, the equity that we have. They talk about share capital, as you can see here. Dividends to shareholders. Can you see? They need to tell us, the directors, that they planning to pay so much dividends, interim dividends. Obviously, most probably these have been paid already. You guys can see the things that we're learning about is something that you're going to see on being big companies when you start working in accounting. You see here, there's dividends to shareholders, interim, there's final. You know what is interim dividends, you know what is final dividends, you know what is share capital. So you can't say you're not understanding these things. So this is a report, director's report. The directors, they're giving us a report on the things that we should be aware of as the external stakeholders of the company. Okay. And then we have audit and risk committee. We are going to talk about this one later on. For now, we don't need to talk about this one. An independent auditor's report. These are the two reports that we're required to know as part of grade 12. These are the two reports that we are required to know. Okay. So now let me go back to the document. We were talking about what? The independent auditor's report. And the first one that we spoke about previously was an unqualified opinion. Okay. I'll get to this one, but I want to go back a little bit so that you guys can understand what is an independent auditor's report. That's what we're going to talk about now. We need to understand what is an independent auditor's report and the types of audit reports that we have. You need to understand that because it's coming in the test. Okay. Look, independent auditor's report, it is a formal opinion, right? It is a formal opinion issued by an independent external auditor as a result of an external audit, which is an evaluation that has been performed on the financial records of a business entity. So which means now the external auditors have to perform what? An evaluation on the financial records of the business, then they're going to issue a formal opinion. So when we talk about an independent auditor's report, that is a formal opinion that has been issued by independent external auditors after they have evaluated the financial records of a business. They need to come to my business. They need to evaluate. What do they do? What does it mean to evaluate the financial records? They're going to check, right? They're going to check the financial statements that we have prepared. And we were doing income statement, we did balance sheet, we did cash flow statement. That is a preparation that is going to be done by the accountants of the company. Then when the external auditors come, they're going to check those financial statements that you guys have prepared to check if everything is valid, everything is accurate, everything is complete. The income statement, when you record sales there, those sales, they must be correct. The auditors will come and check if those sales, they are correct. If they are not correct, they're going to issue an opinion on that. If they are correct, they're going to issue an opinion on that. They cannot issue an opinion without checking the financial statements together with the supporting documents. That is an evaluation that we're talking about. They perform this evaluation by doing what? By checking the financial statements, by checking the supporting documents, because you cannot record something on the income statement when there is no supporting document for that. If you're paying rent expense, if you're recording rent expense in the income statement, there must be a supporting document for that. You must have entered into a lease agreement with your landlord or with the lessor. Then I would be comfortable that you have incurred this expense. And remember, recording an expense only is not enough. We're also checking whether is it in line with the GAAP principles. For example, we spoke about the matching principle. We did say that I only want to see the expenses that relate to the current financial year only. Anything that is after year end, we should exclude. It should not be part of the expenses that are recorded in the income statement. So if by mistake you record rent expense for 13 months or for 14 months, it indicates that there is 2 months extra that you included in the current financial year incorrectly. Then if I'm an auditor, I'll pick that up and you are in trouble as an accountant. So that's why we don't want you guys to do those things. That's why you need to understand the GAAP principles so that you prepare the accurate financial records. Then if I come as an auditor, I'm going to evaluate that and find that everything is perfect. Then I'm going to issue an opinion. But if there's something wrong, I'm going to issue an opinion indicating that no, there's something wrong with these financial statements. If everything is good, I will issue an opinion and say everything is good. So it depends on what I have identified during the evaluation. If everything was fine, I'll be happy with that. Okay, the audit report is generally addressed to the shareholders, right? And serves as an assurance in order for the users of financial information to make informed decisions based on the results of the audit. It is not advisable. It is not advisable for external stakeholders or the external users of financial statements to make a decision about the company without seeing the auditor's report. If I want to go right now and make a decision about these financial statements for Clicks, if I want to go and invest in Clicks Group Limited, I need to go and check the auditor's report and focus on the opinion, the auditor's opinion, and see if the auditors were happy with these financial statements, it means I will be happy as well, and I can invest in the company if I want to. So that's why we perform an audit, is because we want to advise the shareholders. The audit opinion that we're going to issue will go straight to the shareholders. However, not only the shareholders, even the outsiders. The banks, if we want to go and borrow money from the bank will have to check our financial statements. The bank will have to check the auditor's report before they can borrow us that money. So auditor's report is very important, especially for us who are outside the business, because we don't know what is happening inside the business. Whether the monies that they recorded there, they are correct or they are not correct, we will never know until auditors come and perform that audit. Then we can rely on auditors. Definitely we have to rely on them, because they perform what? They perform an evaluation, which means they are checking whether everything is fine or not. Type of audit report. Now, we need to understand the type of audit reports that we have. Based on those audit reports, we will be able to make a decision. So guys, you need to understand these types of audit reports. They're very important. You have to understand them. It's a must. You have no choice here. Okay, the first one is unqualified audit report. If you look at this one, it says unqualified. Someone would say you don't qualify for something, right? If you don't qualify for something, it's like it's something bad, right? But for in terms of an audit opinion, unqualified opinion, that is the best opinion that we can have from the auditors. If they give us unqualified opinion, which means our financial statements were correct, were accurate in almost everything, you did well as a financial accountant. If you are an accountant of Clicks, if you are an accountant of Clicks and you get unqualified audit report, it means you did well as their accountant. Whatever that you recorded in the financial statement was correct, it was accurate, it was supported by the documents. Then it means it's valid, because if something has no supporting document, that thing is not valid. In accounting, unfortunately, you can't tell me that the transaction occurred without having to prove. You have to provide a supporting document, even if you did buy the trading stock, even if you did buy the trading stock. But if you cannot provide a supporting document to me, it is meaningless. That transaction didn't occur. It didn't occur. Even if you, like you telling me that sales were 5 million for the year. But if you don't give me the supporting receipt for those sales or the invoice, remember when you go and buy, like when you sell something, you issue a receipt if the customer pays immediately. Even if you go there and buy Shoprite, they give you a slip. That is a receipt from Shoprite side to indicate that you bought bread and you paid for it. So that's what I want as an auditor, to confirm that someone came and bought bread on this day. Without a supporting document in accounting, the numbers means nothing. The numbers that are recorded in the income statement, the numbers that are recorded in the balance sheet, they mean nothing if there is no supporting document. What is an unqualified opinion? Let's see. This opinion provides, this opinion is provided by auditor when he concludes that the financial statements give a true and fair view in accordance with the financial reporting standards, right? When it gives a true and fair view, which means now the numbers that are sitting in the income statement, the numbers that are sitting in the balance sheet, they reflect a true and fair view. And they are in accordance with financial reporting standards, which means now they comply with GAAP principles. then if auditors find something like, they'll give you an unqualified audit opinion. This type of report is given when the financial statements are free of material misstatements and are presented fairly in accordance with GAAP. You see, what do I mean by saying are free from material misstatements? What does that mean if we're saying they are free from material misstatements? What does that mean?
Does like the source documents and the transaction like confirm each other? There's no discrepancies.
Exactly. So you cannot find something that is not supported by a document. You cannot find a number in the income statement that is not supported by the document, even if like the interest income, even if it's an interest expense. We need to, we do a general ledger for loan accounts there. There must be a statement from the bank indicating how much interest they charged you. Then I would be happy. I would say the interest is free from material misstatements. But now, one thing that is most important here, one thing that is more important is that before we perform an audit, right? Before we start doing an audit, there's something called materiality, right? There's something called materiality. There's something called materiality. I will decide that thing I calculate it, right? I'll go to the income statement and say, okay, fine. You made sales of 5 million this year. The sales are 5 million. For example, in the income statement, right? You made sales or revenue. We have sales less cost of sales. Let me say less cost of sales. Maybe cost of sales are giving you 3,600,000. 3,600,000 rands, and then you're going to have what? You're going to have a gross profit. Okay. So, as an auditor, I'll make a decision to say I need to calculate the materiality before. Okay, then the income statement will carry on other income or gross operating income, expenses, operating profits, and up until the net profits. But as an auditor, I'll come and say, okay, fine. Before I start doing the audit, I need to calculate something which is called materiality, right? Maybe materiality would be calculated as what? As 1%, 1% of sales amount. As 1% of sales amount. So if I have that 5 million, I multiply it by 1%. I multiply it by 1%, which is 0.01. Okay. Then how much is my materiality? It's 50,000. Can you guys see this? My materiality will be 50,000 rands. Okay. Now I have calculated my materiality. So what does that mean? Okay, that is going to be 1%, which is I'll call it my materiality. Okay. Then, which means anything that is below 50,000 is not a problem. I will not bother myself as that, because guys, the reality that you need to know is that in the income statement or the balance sheets, or the whole of financial statements, there are very, very low chances that you may not make a mistake. Mistake will always be there. When you're working with numbers, there will always be errors. All right. You can't, it's impossible to say when you don't make an error. Error is accepted in accounting. It is allowed in accounting, because sometimes you write a number, you add a zero there. That is an error in accounting. So now if we calculate a materiality of 50,000 rand, I mean that anything above this is a problem. So that is going to be a material misstatement. A material misstatement. Okay, because it is above what? It is above materiality. Then anything below this amount is not a problem, which means it is not a material misstatement. So I cannot kill you. I cannot kill you because you made an error of 30,000. And I tell you that, no, I make it a big thing. No, I can't do that. If the error on the financial statement is 30,000, I will still be okay. I don't have a problem with that. I will allow that error. But as soon as the error becomes 70,000, now this one is above materiality. That is a problem. Now it becomes what? It becomes a material misstatement. Now let's go to this thing. I want you to see here. Unqualified opinion, they're saying here, this type of report is given when the financial statements are free of material misstatements, which means now only if the misstatement is material, right? It has to be free from material misstatement. But if there is a misstatement that is not material, it's still okay. I'll give you unqualified opinion. Even if you made an error by 5 rand, I won't kill you for that. It will still be okay. For me as an auditor, I'll say, no, it's fine. It's fine. If you made a mistake of 50 or of 50,000, I will be okay. It's within the materiality. But as soon as you go above that, now it becomes a problem. Now it becomes a problem. This is the best type. Okay, unqualified opinion doesn't mean that there must be no error at all. No. It doesn't mean that there must be no error at all. No. But it means there must be no material misstatement. It has to be free of material misstatement. There must be no material misstatement. Guys, can you hear what I'm saying?
Yes.
Yeah.
It doesn't mean that there must be no error at all. But the errors that you can make there must not be material. Which means it's those minor mistakes, like you are a human being. You are not a machine. You are not a calculator. You are going to make a mistake. But that mistake must not be bigger than 50,000 rands, because that is a materiality that is calculated based on your revenue. Okay, this is the best type of reports that a company can receive, and it is also referred to as a clean opinion. It is referred to as a clean opinion. But one thing that you need to be careful of, with this materiality, it also depends how many errors you make. I can accept one error that is 30,000. I'll say, okay, it's fine. If the error is 30,000, I'll say, no, it's fine. Maybe the error is 2,000, I'll say it's fine. Maybe there's another error. When we start having an error or 3 errors like this, you see all these errors, they are below 50,000 individually. But now, when I combine them all, they become 72,000. In aggregate, they become 72,000. Now it becomes a problem. It becomes a problem. I won't give you unqualified. I will not give you unqualified audit opinion if you made a number of errors, even though each of them individually they below 50,000. But in aggregate, when I add them all, they become 72,000. You failed as an accountant. I will not give you unqualified opinion. The error if there is only one error, should be below 50,000. But if there is more than one errors, all of them, they must still be below 50,000. If your errors, maybe all of them add up to 37, they are below, I'll be okay, you'll get unqualified. Okay, are you happy, guys, with the unqualified opinion? If something is not clear here, you must tell me if something is not clear. But unqualified opinion doesn't mean that there must be no error at all. No, that's one mistake I want you to know. It doesn't mean there must be no error at all. You are a human being, you'll always make an error. You are a human being, you will always make an error, but be careful of your errors. They must be below, they must be not material misstatement. That's why they're saying here, if they didn't want any error, they were going to say they are free of misstatement, which means now we're talking about any misstatement here. Even if it's 1 rand, you must not even make a mistake of 5 cents. Then in accounting, we round off numbers. I can round off to the nearest rand, someone round off to the nearest some cents or whatsoever. You see, the numbers will be different. But that's why we include a materiality issue to say the misstatement should be free of material misstatement, not just any misstatement, but the one that is material, which means it is above materiality. Then it is going to be an unqualified if it is free of material misstatement. So all the misstatements that you're making, they must be below materiality. Qualified opinion. So we're saying here, unqualified audit report. That is the best report we can get, right? From auditors. That is the best report we can get from auditors. Let's talk about qualified now. Let's talk about qualified now. Okay. This opinion is issued when the auditor has encountered one of the following situations while performing the audit. If we find one of the following 2 problems here, there are 2 issues here. One of them will make me to issue a qualified audit opinion. This is not the right opinion at all. The only opinion that is good is unqualified. All these others, qualified opinion, adverse opinion, disclaimer, they are not right. All of them, they are not right. Qualified is not right, but better than the adverse and disclaimer. Disclaimer is the worst. But let's see what does qualified mean. This opinion is issued when the auditor has encountered one of the following situations while performing the audit. A deviation from GAAP. You know we have GAAP principles, right? There's 6 of them. GAAP principles. We have matching principles there. We have historical cost. We have business entity there. We have prudence. If you deviate from those GAAP principles, if you run away, deviation, it means you are not in line. You are moving away from the principle. You are moving away from the rules. Whatever that you recorded in your financial statement is not within the rules because you have deviated. You have moved away. A deviation from GAAP, let's see what they're saying. 1 or more areas of the financial statements do not conform to GAAP, right? Then they're saying are misstated, but do not affect the rest of the financial statements from being fairly presented, which means now other lines in the income statements, they are fairly presented, but only one is misstated. For example, the whole of income statement, only the sales amount is wrong, is materially misstatement. Maybe this one is misstated by 61,000, right? 61,000, only the sales amount is wrong by 61,000, but all the other amounts in the income statements, they are correct. Then I'll give you a qualified opinion because there is one material misstatement, right? 1 or more areas. So which means it can be 1, it can be 2, but all others, they are correct. There is no material misstatement in all other line items. Maybe one or two issues we found as auditors to say, hey, these numbers, they're incorrect. One or two, they are materially misstated. More than 60,000 or 70,000, 80,000, 100,000, 2 million. One or two. One or more. It can be three, it can be four. But if I look at other areas of the financial statements, all others are correct. I'll give you a qualified opinion. One or more areas of the financial statements do not conform to GAAP, that is, are misstated, but do not affect the rest of the financial statements from being fairly presented. For example, if the depreciation is calculated incorrectly, the auditor will qualify the opinion by stating the depreciation misstatement in his report, but will issue a clear opinion of the rest of the financial statements. You see, I'll tell you, they're okay, fine. I've audited the financial statements and I found out that the sales are materially misstated by 61,000. I found an error of 61,000 in the sales amount, but everything else is fine. All the other line items are fairly presented, except the sales amount. If it's a depreciation that is incorrect, I'll state the accept depreciation, which is materially misstated by 61,000, but everything else is correct, which means I'm happy as an auditor. Let's look at the second part, limitation of scope. A limitation of scope, that is a situation where we did not get enough information. Let's see, this occurs when the auditor could not audit one or more areas of the financial statements. For example, although one error could not be verified, the rest of the financial statements were audited and conformed to GAAP. Let's say, for example, I wanted to validate the cash that is sitting in the bank, cash and cash equivalents in the balance sheet. You see here, let's go to the I'll go to the financial statements, right? You see here, there is income statement here. There is income statement, there is balance sheet. Let me just go to balance sheet. You can see here with non-current assets, let's say, for example, here under cash and cash equivalents, you see how much they have. They have 2,704,961 in the current year. Then this one is the previous year. 2 billion actually, sorry. But now, for me to validate this amount, I need to get a supporting document. Which supporting document I need to get is a bank statement. I need to see the bank statement of this company. It must indicate a balance of 2,704,961. But if they are unable to provide me with the bank statement or the supporting document for this amount, then what's going to happen? I will qualify them on the cash and cash equivalent. Everything else is fine. I'm happy with inventory. I'm happy with trade and receivables. I'm happy with income tax receivables. I'm happy with everything in the financial statements except cash and cash equivalents. That's when I'm going to do it. That's when I'm going to qualify them. That's when I'm going to qualify them on the due to the limitation of scope. Although one error could not be verified, the rest of the financial statements were audited and conformed to GAAP. If I'm happy with everything else in the AFS, except cash and cash equivalents, I'll give them a qualified opinion. I'll give them a qualified opinion. You guys can see the difference. Unqualified opinion, no material misstatement at all. No material misstatement. Here, we do have material misstatements, but to one area, only a few area, one area or more. There is a misstatement, or there is a deviation from GAAP for one or more areas of the financial statements. One or more areas of AFS are materially misstated. Right, but all other line items, all other line items are correct. Okay. It's just those few line items. Yeah, right. If I'm happy with everything in the financial statements except inventories, you see here how much inventory they have. They have 7 billion and 63 million, 7 million and 63,280. So now, for me, how am I going to verify this one if it's correct? What must I do as an auditor? How can we confirm this, that this amount is correct? Anyone who wants to try?
Do we go to the notes?
The notes, not really.
Yeah.
Notes is the same as this because it's just the same thing. But now when you want to confirm anything that is here, we need what? You need a supporting document, right? So what can we do to confirm if this amount is correct? You remember, guys, when we record the trading stock deficit, what make us to record a trading stock deficit? What is the reason we record that?
Because
we compared two amounts, ne?
Yeah.
Which ones we compared?
Physical stock taking, and then what we purchased.
Yes, with the stock taking against where we compare stock taking against what was recorded, right?
Yeah.
And which amount we believe is correct between the two?
The physical stock taking.
Exactly, which means this amount should agree to the physical stock taking, right? So we need to go and check the records of the physical stock taking to say the day you were calculating your stock at the end of the year, how much stock you got during the physical stock taking, and agree that amount they got there with this one. Then I will be happy that this one is correct. Am I right on that?
Yeah.
If you compare the stock taking amount with this one, this amount should be the same as the one on the stock taking. That's what we record as part of inventories. If it's correct, I'll be happy. But if inventory is incorrect, I'll qualify them on the inventory and then leave everything else because I'm happy that everything else is fine. But there is audits that we should not be worried about. We just need to understand the difference between unqualified and qualified for now. Okay. Adverse. Adverse opinion. The adverse opinion is issued when the auditor finds that the financial statements are materially misstated, right? Finds that the financial statements are materially misstated and when considered as a whole, do not conform to GAAP. Hey, this was a problem. Everything in the financial statements does not conform to GAAP. Let me repeat this one. The adverse opinion is issued when the auditor finds that the financial statements are materially misstated. So which means now everything in the financial statement is materially misstated. Everything has an error of above 50,000. Everything has an error of above 50,000. And when considered as a whole, do not conform to GAAP. This means that the information is materially incorrect, unreliable, and inaccurate in order for the auditor to form an opinion on the financial results and financial position of the business. The company will therefore have to correct the financial statements and obtain another audit report. Adverse is unacceptable. It is unacceptable at all. I can accept the qualified. Because not everything is incorrect. Only few line items are incorrect. I can qualify. I can say this one is fine because one or two things are errors, big errors, one or two errors there. You get unqualified, no big errors here. Here, there is one or two big errors. But in the adverse, Hey, everything, there are big errors. In everything, like in all the financial statements, there are big errors. This one is a red flag. This one is a red flag. That is an adverse. Materially misstatement, materially misstated. Okay. Disclaimer of opinion. This type of report is issued when the auditor cannot perform the audit and consequently refuses to present an opinion on the financial statements. This report will be issued when the company willfully hides or refuses to provide evidence and information to the auditor. The financial statements will therefore be rejected by stakeholders of the company. You see now, disclaimer is worse, is worse, is worse. I go and audit the company. I ask them, can I get the invoices that support this sales amount? They're not giving me. They're telling me that they returned stock to the supplier. Can I get a debit note? Can I get a credit note? They're not giving me. They're telling me that inventory is 10 million. I'm asking the results of the physical stock count so that I can verify that they cannot provide. Cash and cash is 2 million. Where is the bank statement for me to confirm that they cannot provide? Trade and other receivables. They're telling me trade and other receivables is 5 million. Where are the data statements? I want to verify that they cannot provide. They're telling me that trade and other payables is 6 million. Where are the creditor statements? Because those are the documents that I need to verify the amounts. They cannot provide. They're telling me that they have an insurance expense of 6,000. Where are the documents to support that? Cost of sales. Where are the documents? Everything I need, they just look at me. They're not providing anything. What must I do as an auditor? What must I do? Must I listen to them? What can you do, guys, when on your side? What can you do? You are an auditor. You asking, because as an auditor, you only rely on the supporting document. You will never know whether these amounts are correct. You will never know. You will never know whether these amounts that are sitting here are correct until you see the supporting document that prove that share premium, share capital is 2,081. You need a supporting document, the share certificate here. That will prove that. There is trade and other payables here, 10 million and 30. You need a supporting document here to indicate, you need your creditor statements to indicate the balance, to say you owing people 10 million and 30,000. Can I prove that? You can't. They just can't provide anything, these people. They cannot give us anything. I will just issue a display. I will not even do an audit. I will stop and say, okay, fine. I give them a disclaimer. I will not even issue an audit report because I cannot do anything. Okay. Okay. Adverse AFS as a whole are materially misstated, which means there are big errors in all areas of the AFS. Big errors in all areas of the financial statements. When I'm saying AFS, I mean annual financial statements. Let me just do this. Financial statements as a whole are materially misstated, okay? Disclaimer. We did not obtain information, therefore we did not perform an audit. Let's go back. This type of report is issued when the auditor cannot perform the audit and consequently refuses to present an opinion on the financial statements. We do not present the opinion due to not receiving supporting documents. Documents needed to perform the audit. Okay. So guys, if you in future you become a financial accountant, if you become a financial accountant in future, make sure the aim is to get unqualified opinion. That is the aim for you, is to get unqualified opinion. The aim is for you is to get unqualified opinion. Okay. Okay, let's get on here, guys. I want us to go to a director's report and go through it. Director's report is not a big issue more. It is not a big issue, the director's report. Just that the directors here, they just providing us an idea of how did they perform during the year. How did they perform? It's like a principal of the school giving us an idea, how did the learners perform during the year? How many learners passed? How many learners failed? How many learners from grade 12 they passed, grade 10, grade 11, all grades? What does the school need to improve? It's something like that. Same thing with the company. The director, they must provide a report on that. How did the company perform during the year? What were the struggles of the company? All those things. The Companies Act 71 of 2008 requires that every company must present a director's report, as this report is considered to be part of the annual financial statement of the company. It is subject to review by an independent auditor. Because here, this director's report is going to state that we made a revenue of 5 million. I will have to check as an auditor to say, are they correct or they lying if they say that? They will tell me that they made a revenue. You see here, how much is the revenue? It's 48 million. If we can go to the auditor's report, to the director's report now, if we can go to the director's report now and see if whatever revenue they're going to talk about there will agree to this one. It's something that we're definitely going to check as auditors. Okay, let's go and see. Let's go and see to the director's report. You see, there will be numbers there. They will like state some numbers there on the director's report. You see, group financial results. Look what the results of operations for the year are set in the consolidated statement of comprehensive income on page 9. The profit attributable to ordinary shareholders for the year is 2,837.1, or that is 2,837.1 million. So this is the profit they're talking about. You can see they're talking about what? They're talking about the profit. So if I go to the financial statements to check that, which is going to be 2,837, I need to find the same thing there. If I can go to the income statement, I need to go and see the same thing there. If I go and check the profit here, if I go and check the profits there, you can see, guys, there that the profit is the same. Where is it? You see, total comprehensive income for the year is 2,837. Can you see? So that's why we have to check it as directors. The profits that they're talking about here, there is it also there, 2,837. Between one of these two, they're talking about one or this one, between these two. Okay. That's what I wanted to share with you. We have to check that. Okay, the directors are required to discuss in the director's report any matter which will assist the users to understand the company's affairs and the financial statements in particular. Consequently, the Act requires directors' report to include the following. Let's see. The state of affairs of the company, including any matters material to the shareholders. Everything that we need to be aware of as shareholders, directors must tell us. Directors must tell us, because remember, we prepare the financial statements at the end of the year. If we reflect everything today, if today we prepare the financial statements and everything is finalized today, and tomorrow all the assets of the company, they got burnt, or maybe there is fire in the warehouse of the company, they must tell us, directors must tell us that, okay, fine, the company made a profit of 1 billion. It's a profit, we're happy, but the company is gone because a day after that, all the assets of the company got burnt. So if the company is gone, they must tell us all of that, because that information is material. I can't just see the income statement indicating a profit, indicating a good cash flow and all of that, and then, but the company is no more. So the directors, they must tell us everything, because it's possible that we prepare the financials today, we finalize them, indicating the profit, and then tomorrow something happens. Maybe they are floods, maybe they damage the company, they damage the inventory, all the assets of the company are gone. Once the company has no assets, there is no business. What are you going to do without assets? Because we generate income using the assets. If those assets, they're no longer available, which means there's no company. Number two, the nature of the business of the company. So directors have to explain the nature of the business, which means now they telling us what is the business doing. They must explain that. Let's go and check if these ones, they do tell us the nature. Let's go and see. If the directors, they do report on the nature, you can see here, there is the nature of business. The company is an investment holding company listed in the food and drug retailers sector of the JSE. It is a subsidiary of House, South Africa's leading health and beauty retailer, and its leading pharmaceutical distributor and wholesalers, amongst other businesses. The company operates in Southern Africa. You can see they did tell us about the nature of the company, which is a requirement. Profits and losses of the company, directors must tell us about that. And they did tell us about the profit and losses of the company. It's there. You see, director's report is very important, and it is a requirement by the law. The report must also contain any prescribed information. It must be approved by the board of directors and signed by an authorized director. That report. The report must then be presented to the first shareholders meeting after the annual financial statements have been approved. So this must be signed. It must be approved by the board of directors and signed by an authorized director. Usually the director that signs the financial statement is a non-executive. You remember, the guys, that we have executive directors and we have non-executive directors. Do you still remember the difference between those two? What is the difference between executive and non-executive?
Executive directors run the business, do the daily running of the business, and then non-executive, they only show up to the meetings.
The non-executive, come again on that?
I'm not too sure non-executive, but the executive directors do the daily running, and then the non-executive directors only come by the AGM.
Yes, that is true. That is correct. That is correct. That is correct. Non-executive, they're not involved on a day-to-day running of the business, but the executive directors, they are involved on a day-to-day running of the business. So they must sign. As you can see there, we have different signatures there. We have different independent non-executive chairman. We have different signatures there. They must sign the report, the directors. We have CEO there, which is the chief executive officer, We have a chief financial officer. You see, they are signing. They have to sign as required by the law. Look here, as it states there that they must sign. Okay, it must be approved by the board of directors and signed by an authorized director. Okay, the following information can be disclosed in a director's report unless disclosed elsewhere in the annual financial statements. A review of the business future developments and events. Those are the things that should be part of the director's report. I saw events are there. I saw events, they are there. They were like, you see there are events after reporting after the financial year. As I was telling you guys that if today we prepare the financial statements and then the day after the company's assets, they get banned, they must be reported. That has to be reported here to say the company operated very well the whole year, but at the end of the year, things went south and then something happened. The company is no longer existing whatsoever. Any significant events they may have occurred after the preparation of the financial statements. Can you see? After the preparation of the financial statements, we have to let the shareholders know about that. Because the financial statements reflect on the whole year. But what happens the day after the year end? First day after year end, if the year ends 31 December, remember, the financial statements will report up until 31 December. But on 1 January, if something happens and the company is gone, how are the shareholders going to know about that? The director's report must report that the company is a going concern. We know that going concern is one of the GAAP principles, right? Indicating that the company will still be able to operate 12 months after the year end. 12 months after the year end of the current financial year. Directors must indicate whether the company is still a going concern. That thing is supposed to be somewhere here. I'm not sure if it's here, but it has to be included in the report. I'm not sure if they did include it. I don't see it, but it has to be included, whether the company is still a going concern or not. Share capital, they must talk about share capital. I saw that one is here. There is share capital. Okay. You guys can see the things that I'm teaching you here. These things, they exist. It's not a theory that you will never see in future. These are the financial statements for 2024 financial year. These are the latest financial statements. Recent AFS. You can see the share capital here. Things that we're talking about at a grade 12 level, you can see them in the set of the financial statements. Names of directors, powers of directors, directors' interest in the company meetings and attendance at meetings, remuneration of each individual director, those ones have to be reported, distributions, dividends to shareholders, those things are here. There is dividends to shareholders, they are reported. This is a grade 12 accounting. Special resolution approved by shareholders, a report on corporate governance and the application of risk of the recommendations of King 3. I did say that now it is King 5, but don't worry about that. These are not the things that you should stress yourself. A report on board committees, for example, Financial Risk and Management Committee, Audit Committee, those ones, they are there separately. The audit committee is here. There is audit and risk committee. They reported separately. Information in respect of health, safety, environmental issues, and community responsibilities. So you understand what can you expect from the director's report. They're just telling us more about the company because they are the ones who are running the company. They know everything about the company. So their report is more of about telling us as shareholders about the company. Then when it comes to the audit opinion, that is coming from the auditors. Then they need to sign the audit report. Auditors need to sign. They need to sign the audit report at the end to indicate that they completed the audit. As you can see here, who signed this one? This one was signed by these ones were signed by KPMG. As you guys can see here, So which means this company is audited by KPMG. KPMG is what? Is one of the auditors. You can see here. KPMG registered auditors. So they are that is an audit firm. KPMG. That is an audit firm. So these are the things that we should be aware of, guys. Other than that, I'm not sure if you have questions. If you have questions on your site, you can let me know, okay, guys. Any questions on your site? How are you feeling about these reports? Because next time now we're going to do some questions. Yes, come Kinela.
No questions, sir. Could you
Okay.
send the work that we did from the 2nd of March? Because I didn't get any more emails after the 2nd of March for the work that we did.
Yeah, no, definitely. I will send that. I will definitely send that to you guys. I think I forgot to email you all of those things, but I'll send the spreadsheet. I'll send everything. Another thing I wanted you guys to know about is the videos on YouTube. Those videos I did load them on YouTube. You must go to YouTube, search there on YouTube, and then you will be able to see them. You must go through all those videos when you revise and everything, because we're gonna do the revision, but it's gonna be the same thing that we did. You can see here, if you go and search PBK tutoring there on YouTube, and then you go to the channel there, you should be able to see all the videos loaded there. I'm still gonna load the recent ones that we did this week and probably last week, but you can see we have the videos here from the class one. Class one, that's where we started up until the latest video. So these are the videos that you must visit, watch them whenever you need to. And then after that, everything will be okay. Smanga, on your side, do you have a question?
No.
No question. Okay. Okay, good guys. Thank you. Thank you. Thank you, guys. Goodbye. I wish you a lovely evening. Né?